Yeah, so if you look at it from a longer run perspective, Indonesia's rating has been moving up, gradually over the years. And this could continue if strong reforms are going to be implemented. So I mentioned the dependence on external financing as a challenge, the low government revenue, and there are also some lagging structural indicators, for instance, governance standards. And if the government would manage to implement strong structural reforms, for instance, through the Omnibus laws, that could be significant from a ratings perspective in a positive sense. So, for instance, if you look at the Omnibus Law on job creation, we will be looking at the changes in terms of, for instance, the labor market flexibility. If you look at the flexibility of the labor market, the severance pay requirements in Indonesia are among the highest in the region, in the APAC region, if not globally. So from an investor's perspective, those kind of changes could be significant and could lead to higher GDP growth in the medium term, and also higher FDI inflows. And higher FDI inflows would be one of the ways, basically, to improve the external finances of Indonesia, and to, like I mentioned earlier, the way the current account deficit is being financed, that would be improved.
Our government keep reiterating that our existing debt burden is still somehow relatively secure and safe for our macroeconomy. Using your perspective, if we may have second-hand opinion, what do you say on this?
Yeah, I think the general government debt level is relatively low at 30.1% of GDP. That's our estimate for 2019, and that's lower than peers. And what we're generally seeing in Indonesia is also that there's broad support among different political actors for a prudent fiscal policy. So that's positive. Now, at the same time, it's important to realize that general government debt as a percentage of government revenue is actually higher than peers. So the issue is more on the revenue front. But we do expect the debt level to remain in check. So basically lower than in peers for a number of years to come.
Well, having said that, how makes sense will it be then when the government say that it means that it's still realistic to add more when we talk about the existing debt burden to maximize our growth, let's say, through debt? What is your calculation on this, where the government say that we still have actually space for more debt in terms of the macroeconomic building and stuff?
Yeah, I think there is some space in the sense that, of course, there are the fiscal policy rules, so the 3% of GDP deficit ceiling. So there is still some space in that sense, and if the fiscal deficit would be closer to 3%, then the debt level would be slightly higher than what we currently expect, but in some sense, would still be relatively stable, close to that 30% of GDP.